Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Please don't forget to like and subscribe. Click the bell so that you get a notification of when we're releasing a new video. I'm sitting again with Michael Porter. Welcome, Michael.
Morning, Robin.
Michael, we've been sort of going on at length this year about interest rates, central banks, inflation, and this week has been quite a busy week. We've had the ECB, we've had Jerome Powell in America, and they've raised rates. But I think also there seems to be that inflation is on the decline. Tell us what's happening. Are we at the end? Is it hallelujah times in sight, or do we need to be a little bit cautious?
Yeah, Robin, markets all over the place, but there is a lot going on at the moment. And really this week, the US Central Bank, the Fed raised interest rates on Wednesday night, as widely expected. But as we sort of said last week, it wasn't really, everybody knew they were going to raise rates, as did the ECB yesterday. It's really more around the commentary now and the nuance and where we're going from here and trying to decipher whether a word means aggressive or not aggressive. You know, they can change their statement by one word and the market gets very excited. So you're actually going to be an English expert to be an investor these days. But yeah, the Fed is certainly indicating that from here on out, it will be data dependent whether they raise rates further. The ECB sort of said a similar thing, and the Reserve Bank, our Reserve Bank, said a similar thing the previous week. You know, so the market is basically interpreting this now as saying, well, we're sort of at peak rates. You know, if we're not there, we're very close to there. So it's not a dead cert. At the next meeting, there's actually going to be quite a lot of volatility around the next meeting because it's going to be. You're going to have different interpretations whether markets think that rates are going to rise further or not. But it's data dependent. So every time that some data comes out, we're going to see some sort of reaction.
So Michael, the volatility that we've had up to this point has been really about, are we going to raise, are we not going to raise? But would it be fair to say that the future market volatility is really going to be around how long we stay at these levels before we start falling?
Yeah, exactly, Robin. So yesterday, I mean, for example, so the rand's been really strong, and we've written about it in Intuition this week, where you get to sort of peak rates, the dollar starts to weaken, and obviously the other side of the currency benefits. And the rand got down to 17.50 yesterday. This morning it's 17.90. Now that's a big move. Now it's not back at 20 where we were a couple of weeks ago, months ago, but yesterday. US GDP came out for the second quarter, sort of advanced GDP. So this is the sort of first reading. It was much stronger than expected. So essentially the immediate reaction of that is, the economy is actually doing a lot stronger. Maybe interest rates aren't at their peak yet. But I think the other interpretation, as you quite rightly say, is I think investors have to be a little bit realistic about how quickly interest rates are going to fall. We could now have a sort of Table Mountain kind of shape. They've risen very quickly, and we go flat for 6 months or 9 months. I don't think we should be expecting interest rates to be falling by the end of this year. Certainly only into next year.
So if interest rates stay like that Table Mountain that you're talking about, I mean, how typically will that play out? What does it mean for companies and the financials in company spaces?
Yeah, Robin, I mean, listen, your finance costs are then, your interest rates aren't changing. I think it certainly gives companies breathing space and they know what they're dealing with. So when rates stop, I think the whole momentum changes and companies obviously look at their financial structure. So it does start to take the pressure off. I mean, you're not having this constant rise in interest payments, but yeah, it doesn't provide relief, but it does provide certainty. And I think that's, from an investor point of view, certainty and a sort of a clear path of the trajectory is actually almost more important than actually if they start falling or not. If you can sort of see that we're flat and the next move is down, then markets will start to price it in. But it's the uncertainty. Are they going up? Are they going down? That causes all the volatility. But if we have some really strong data, some strong growth, some inflation numbers that don't maybe come down as quickly as anticipated, I think we could see some big volatility in the markets in this transition phase.
Yeah. So, I mean, everyone's been looking at the inflation numbers up to this point, but maybe it's fair to say that the inflation numbers are still going to fall, but interest rates aren't going to fall unless we see that the economy is not overheating in the States. Is that the correct assessment?
Yeah, so it's kind of a good news is bad news and bad news is good news story.
We're back there again.
Yeah, if the data is too strong, that's actually going to be interpreted as bad news.
Yes.
You know, so you kind of want. Well, we were talking yesterday, just you and I, about the Goldilocks scenario: not too hot, not too cold.
Yeah.
You sort of want that. You know, that's the holy grail of where the market wants to go. But I'm not sure we're really going to achieve that.
Yes. Yeah. Well, Michael, that's very interesting, and we will obviously watch that very closely and continue to report it here on the Money Morsel and keep you updated. Michael, thanks for giving us your time.
Pleasure.
Thank you for joining us. We'll catch you next time. Bye-bye.